some reaction now from the experts on the latest from the Federal Open Market Committee. Two former members, Bob McTeer, a fellow now for the National Center for Policy Analysis, and in addition, it says here, to former Dallas Fed president and member of the FOMC. That was well written, wasn't it? Also, former Cleveland Fed President Lee Hoskins joins us, and we got Rick Santelli standing by as well. Bob, the question we all ponder here as we watch the news conference, as they extend the low rates through the end of 2014 and keep rates unchanged for now, what is the message that's being sent to people watching right now who are investors and homeowners and consumers? What does it say about the state of the economy right now?
Well, his purpose in doing that is to keep longer-term interest rates low. There is some effect on the market of that kind of pronouncement. If I'd still been there, I would have resisted that greatly. I thought it was a mistake to say they were going to keep them that low through the middle of next year, and it's even a bigger mistake, I think, to say they're going to do it through 2014.
Why?
It does have a positive impact, but it just removes flexibility. They don't have the same flexibility they would have.
Lee, is there also the possibility that people look at this and say, for example, if they were thinking about buying a house, now it's removed the urgency? I know part of the mission of keeping long-term rates low is to perhaps push people to other asset classes. But does this send the message that, boy, I can stay in short-term treasuries, they're going to be safe, I don't have to worry about a backup in rates?
I think people are going to buy a house or not buy a house, not based on where the rates are today, and whether the Fed can twist the yield curve down anymore for mortgages is problematic at best. I think people make decisions for other reasons with respect to housing. I thought there were a couple of markedly good points that Bernanke made. One, we have an explicit inflation rate target, and second, he rejected, and the committee rejected out of hand, any notion of targeting the unemployment rate for the right reasons. They don't control the unemployment rate. The dual mandate has caused logical problems for economists at the Fed. The negatives are the target rate is too high. Zero's the right place for inflation to be. If Fed hits its targets for 10 years, the purchasing power of the dollar will be decreased by 25% for people who are on fixed incomes. Okay. So Bernanke was a little disingenuous on that. The other is Lacker's point. Lacker's point deserves credit, and that's the same one that Bob was making. There's no sense in tying interest rate moves to the calendar. Tie them to the forecast. That's the whole point of having an interest rate and an economic forecast.
That's Jeffrey Lacker, the Richmond Fed, who's now a voting member of the FOMC. Rick Santelli, you said earlier you felt with this new maneuver and now the extension to 2014 that our Fed's starting to act like the Bank of Japan. What'd you mean?
Well, I think the Bank of Japan had a lost decade. And, in my opinion, the crisis in many ways began in 06, 07 at the latest. So our decade is, if you take that to 2014 and some comments made hinted 2015, there's your decade. And maybe the only difference is that the Japanese at least had a lower unemployment rate during their lost decade than we did.
Rick Santelli, the 10-year yield dropped markedly when we first heard this. Now it's back around 2%. What do you make of the reaction? We are seeing a big drop, of course, in the 5-year yield here.
We emulate Europe in so many ways, whether it's healthcare, whether it's jabbing at the banks, taxation. This is another way we're emulating Europe. They have a long-term refinancing operation, do they not? And it's 3 years. Let me see. 2014 minus 2011, 3 years. I think we just implemented our de facto operation.
Bob McTeer, we're going to lose our window here in a moment. Let me just ask you your thoughts on where you think our economy is now and is it heading. Are we seeing enough of a pickup in employment right now? Are we seeing an improvement in housing? Or what do you think's going on right here?
It's much better than it was, and I certainly hope it doesn't trigger another a round of quantitative easing on the Fed's part. I think it's pretty good.
Lee Hoskins, what do you think?
Yeah, I think the economy is more than just limping. It's not growing at the rates that people would want it to, but there are a lot of good reasons for that. And the Fed can't push the economy into real growth. Bernanke essentially said that today, certainly over the long term. And we're well into the medium term now. It'll be 3 years of recovery come June.
Alrighty.
Some recovery.
Yeah.
Thank you for your patience and waiting. Thanks. See you later.